Felix here. Less than 12 hours to inflation data, CPI, and my chief financial analyst, Tallulah, says, be prepared. I'm going to tell you how to be prepared. Before we get to that, brand new benchmark out. Get your hands on it today before I take it away. felixfriends.org/NASDAQ, a full core fundamental number bonanza of the NASDAQ 100. It looks just like this. It is like this. And what you can do, like you see all the 100 stocks, and you could resort them, say, by return on capital invested, which is, I think, one of the most important numbers. And you could scroll down, you see Apple's got the highest number, followed by Accenture, followed by, well, look at it into yourself. Get your hands on it, play with it, mess with it. It'll make you into a better investor. I promise you. felixfriends.org/NASDAQ. You need to know this stuff. Now, let's go into the heart of this. The disclaimer. This isn't financial advice. No, it's not. It's just some guy who takes financial advice on his cat. So don't be silly and base your decisions on what I'm telling you. I hope just to make you more informed and, well, be able to be in a position to make better decisions. Now, what's this? This is the United States inflation rate, just sort of hovering at 8.2%. Now, it's been going down a little bit, very, very moderately, but not a great deal, right? 3 months here. 4 months if you count that one, but I guess that one was going up. So what are we hoping for? Well, let's run through the scenarios here. But before we run through the scenarios, let's look at what's likely. Now, what the bank really cares about, and by that I mean the Fed, is the 5-year or 10-year break-even rates. Essentially, what's the expectation of inflation? The expectation at the moment is that long-term inflation will be about 2.6%. They can sort of live with that, but really they want this to be at 2%. So it's not. They want it to be anchored. They want it to be at these low levels. So that's a biggie to see where that's coming in at. And then a lot of people are saying, well, commodity prices are coming down, aren't they? Well, are they? It sort of looks like it, doesn't it? At least from the summer highs. But this is October inflation. So what's October inflation really mean? Well, let's put a line in here where October begins. So that's where October begins. That's where October ends. And what's our comparison point? Well, last year's October, really, or the previous month, because we also look at the previous month. So are commodity prices lower at the end or on average in October? This is the OCT, October, then in S for September. I'm not going to write out all of September because it's going to be too hard. Yes, I think it's fair to say they are lower down here than they were on average. They were a little bit more like that. So I think on average, we're probably still a little bit lower. Not a lot lower, but a little bit lower. So what happens if we go back a year? Well, we go back to last year, October, and we are looking at this time period. And what happened? Well, looks like commodity futures, and this is what this is, are significantly higher now than they were back then. How much higher? If you just sort of go to the average point, about 10 percentage points higher. So actually commodity prices falling since the summer isn't really going to help us all that much. It might help us a bit on the month-on-month number, but not a great deal on the annual number. So I'm not hugely optimistic looking at this data here. Now, the core inflation, this is also really, really the key thing here, because that strips out energy. So you can't blame the Russians for it. You can't blame anyone else. And that's been going up the last 3 months. And that's the problem. That's the underlying real US inflation. Now, if you think there isn't any inflation, well, did you see the US steel deal? I think the union got something like 21% over 4 years, plus a bonus and another bonus and another bonus. So you're looking at, what, 7% wage inflation a year or something like that? That's pretty significant. That's not no wage inflation, which is what we've been told we would get. So tomorrow morning, right at the open, you're going to see this data coming out. Inflation rate, core inflation rate month on month, core inflation, and then the jobless data. So what should you really be watching out for? Well, the media, the uninformed media masses are basically just going to look at this inflation rate here, and they're going to be like, well, we're expecting it to be 8.1. If it comes in at 8.1, it's going to be pretty good. If it comes in at above 8.2, not great. 8.3, not great. Comes in at 8.5 or something like that, and all hell breaks loose, essentially. Core rate, similarly, we were expecting it to be sort of pretty flattish. And that's what I'd look for. I'd look out for the core rate month on month. That was 0.4% last month. We're actually expecting that to be a little bit higher. And also look at the initial jobless claims. You want these numbers to be high, and you want the continuing jobless claims to be somewhere ideally in the 1.5 million range. And I don't mean that as in I want people to be unemployed, but that's what the Fed is sort of dictating. Now, why does it matter? Well, very simple. Higher inflation means what? Well, higher inflation does two things. One, it means we get higher interest rates from the Fed. And let's run through that thought for a second. So higher interest rates from the Fed do what? Well, they make borrowing more expensive. That applies to consumers, but also to companies. And secondly, well, higher interest rates do another thing. They increase the yield on government bonds. Now, when we value stocks, we compare them to the risk-free investment, which we assume government bonds are because we think the US government is going to pay their debt. That, therefore, reduces the value of stocks, especially of growth stocks. What's the metric here? Well, approximately a 1% increase here leads to about a 9% increase on stocks. So pretty significant, right? And the other part, of course, is that the higher borrowing higher borrowing cost does what? It reduces consumer expenditure because they have less free cash, essentially. And what does it also do? It reduces investment by companies. They're not going to build as many factories and so on because the cost of borrowing is higher. So what does that do? Well, the expenditure increase in consumption, decrease rather, reduces demand, right? Less investment reduces demand. So what does that do? Well, both of these lead to the great big ugly recession. And what happens in a recession? Well, you get into this vicious circle whereby you essentially are reducing confidence. And consumer confidence and business confidence dropping, CEO confidence is at pretty much all-time lows, does what? Well, it means consumers spend less and companies invest less. So how do you break that spell? Well, normally the Fed comes in and the Fed reduces rates. That's sort of the cycle that we go through every couple of years. But yeah, bear in mind the valuation of stock story as well, because that's a big deal. And that's why you see this particularly for growth stocks, because inflation is a bigger deal for them because we look forward, say, 10 years and say, how much money is Palantir going to bring in 10 years? We then have to discount that back. If inflation is very high, if borrowing costs are very high, the discount factor is going to be bigger. And the way you can get your mind around that is like, if I said to you, I'm going to give you $1 million today, you said, Felix, you're very generous. Or I say, hang on, how about I give you $1 million in 10 years? Which do you prefer? And obviously you take the $1 million now. Now, what if I said, I give you 1.1 million in 10 years or $1 million now? Now you still, if you're a rational human being, going to take the money now. But the higher inflation is, the bigger the number I'd have to give you in 10 years to incentivize you. If I say I'm going to give you 2 million in 10 years, you might be thinking about it. But then if you run the maths, it really depends on what the inflation numbers are. So that's essentially what's happening here. So what are the projected outcomes that we've got going on here? Well, essentially, as I say, if you get a kind of a flat reading, and especially on core, that's what I'd watch out for, then everything is kind of right. Not a great deal happens. If it's, say, 0.1% plus or minus, we're also okay. A move down of more than 0.2% or thereabouts would cause a rally, in my view. And similarly, a move in the other direction would cause a fairly hefty shock, especially to the sort of QQQ element there. So what can we do out of this? Well, it's going to cause volatility. That's the one thing it's definitely going to cause. And we can make money out of volatility. We always do. How do we do that? Well, we trade options. Options isn't really about stocks. People get it wrong. People think it's a stock trading leverage. It really isn't. It's trading volatility. And once you understand that, and you understand you can have an 85% probability on setting your trades up, 85% probability, that's kind of what we aim for, then your whole universe changes. When people explain to me A, volatility, and B, probabilities, I was just blown away. My head hurt for about 3 days, and then I thought, this can't be true. Too good to be true. But no, it is. And that's how I've made 114% so far this year on my options portfolio. So something to think about and to possibly learn. And you can do that with us. We've got a marvelous coaching program. I say marvelous. No, the community is really fantastic. A bunch of very motivated people who are basically wanting their own extra income stream and maybe quit that 9 to 5 and just get more freedom. So what do you need for it? You need a 5-figure portfolio, or 6 or 7 or 8 or 9 figures. And you can go to felixspencer.com/coaching. Give us a ring and we'll walk you through it, answer all of your questions on exactly what it's like. There's a video also on the website which explains exactly what it looks like, and testimonials from existing students and so on. So check it out. It's a marvelous community. If you're not quite there yet with 5 figures, then we've also got you covered. We also have a pre-recorded version in a sense. So it's about 100 lessons plus. You get to see me trade live every week. You get access to my master options portfolio. You can see me put the trading strategy that I've developed, the protocol, into practice. And you see that every week, and every single trade that I've done that got me to 114% this year, I've done it either on a live stream or I notified you guys live as I did the trade. And I think that's really important, not to show that I'm amazing at trading. No, the point is that I'm being transparent about what I do. And I think that's one of the things that's really missing here in this industry. So that's why I do it. I want to show you when I win. I want to show you when I lose, and actually, especially when I lose, what we can learn from that. But we're doing pretty well. So check it out, felixspencer.com/options. Here it is, coupon code there, freedom. And I thank you for watching, and I hope you join me tomorrow morning live for the CPI data coming out. We'll analyze the numbers as they come out, dive deep into them, and see how we can make money from it.